folks. My name is Adam Roberts. This is my wife, Emily Courtwright, and we're excited for you to join us in a presentation on our latest investment opportunity, an oil and gas exploration fund, CapX Ventures Fund 6. Now, a few years ago, Emily and I were very busy getting heavily invested into real estate and specifically multifamily apartment communities. And it's been an absolutely fantastic asset class for us. We, however, realized that we were very concentrated in one single asset class. And over the past couple of years, if you've been following our journey, you'll have seen that we have branched out and started investing in other assets and diversifying our portfolio. We have put a special emphasis on cash flowing assets, as we've seen the benefit of a high velocity money coming back to our portfolio so it can be reinvested quickly. And also we've put a big emphasis on uncorrelated assets. So investments that don't exactly track the same as real estate investments. And I think that's what you'll find in this oil and gas opportunity. So we're really, really excited to take you on a journey and see what we're seeing in this opportunity, CapX Ventures Fund 6.
So let's look at a high-level overview of the project, and we're going to go into more details on all of these different bullet points. At a high level, A&E Investments is joining CapX Ventures and Rosestone Operating Company to drill 4 new wells in northwestern Louisiana. And the actual area is called Claiborne Parish, and parish is just another name for county. So Claiborne County, Claiborne Parish. The projected returns for the project are 4.1x. So if you invest $100,000, you'll get $410,000 back, including your original principal, over 5 years. Now, you'll get your entire $100,000 back in that example in the very first year, based on the projections. Now, Rosestone is the one that is actually going to be boots on the ground. They are the operator with over 20 years experience drilling in this specific area of northern Louisiana. So we're going to go into more details on them later. And then the returns are based on really conservative production volumes versus the neighboring wells. We're going to talk about the comparables. We're going to talk about the different well production. And I do want to say that this offering is only available to accredited investors. So if you are a non-accredited investor, unfortunately, you'll have to wait for the next opportunity. It's only open to accredited investors, and we do expect to have bonus depreciation. So let's jump into the details. So we're going to talk about a couple different, big topics: who, what, where, why, and how. And the first big question is who. The most important question in almost any deal, any project, is who is leading it. And Rosestone Operating Company is the most important who in this partnership. And that is because Rosestone is the one actually doing the drilling, actually the one being boots on the ground, doing the extraction, having the employees there. They have been experienced for probably 40 years in the oil and gas industry. They have 3 main principles of the company, and they have competencies that span geophysics, oil and gas law, finance, operations. And in this specific Claiborne Parish, they have drilled over 50 wells since 2007. Now, CapX Ventures has worked with Rosestone in their last full cycle deal that we'll talk about in a few minutes. And Rosestone has proven to be a great operator to work with. Just really amazing reports, communication, timely and accurate drilling. And so we are really excited to work with Rosestone again in collaboration with CapX Ventures for this project. Rosestone Operating Company is the one that completed the feasibility studies for this investment, and we're going to share some of that comp data with you here in the coming slides. And so just know that Claiborne Parish is Rosestone's core competency. It is their bread and butter. It is the location that they prefer to drill in because they know the location so well. So we are really excited to work with them.
The other partner in our deal, CapX Ventures, principals are Will Crozier and Jason Sharp. Now, Jason and myself go back several years as a friendship in the aviation community. And quite ironically, we were also both involved in multifamily investing together through a few years, but didn't know each other through those avenues. It was more in the flying community. Importantly, though, Jason and Will have been partnered throughout the last decade or more in large value add multifamily acquisition, repositioning, and more notably, providing investment returns to their limited partners in excess of 178% return on investment with an average of a 3-year hold time. And so CapX Ventures really comes from a strong pedigree of performance and track record, which is, again, with along with Rostone Operating Company, makes this a very lucrative investment for Emily and I when it comes to relationships and the folks who are actually running the deal. In the oil and gas space, CapX Ventures has roughly 15 million of assets deployed across 3 energy funds. Their most recent full cycle fund, which Emily discussed with Rostone, accomplished a 92% return in 2.5 years. Additionally, CapX holds a working interest in more than 200 wells across Texas and Kansas. They participate in projects such as this one, which is new production drilling. They also acquire, rehabilitate, and reposition existing value add wells. And as we'll get into in just a bit, they have a specialty and expertise around Bitcoin mining, which goes hand in hand with some of the activities in the oil and gas space.
And then who are A&E? Adam and Emily. We transitioned from our engineering roles back in 2013 to pursue real estate investing. And we started with single family flips and rentals, transitioned to multifamily. And then, like Adam mentioned, the past 2 years, we have really diversified into other uncorrelated asset classes. Overall, in our personal portfolio, we have averaged a 22% annual return on our investments. And so we are inviting you to invest in the same things that we invest in so that we all can grow our wealth together. Now, our primary focus since 2017 has been on multifamily syndications, and we have averaged 1.8 equity multiple in 3 years on the full cycle deals that we have done in the multifamily space. Now, one of our primary targets is to offer other people, our investors, a diversified opportunities for different investing. And so whether that's cash flowing, whether it's short term, whether it's long term, we have a suite of opportunities available. And bringing this oil and gas opportunity to you meets quite a few buckets. It meets the cash flow bucket, and it meets the, I would say, midterm bucket. And so that is a really, really great opportunity to grow your wealth, grow your assets alongside with us. Now, Adam serves as a coach in the multifamily mentoring space, and I also teach wealth building classes across the nation through Keller Williams. And so if we can help you in either of those categories, please let us know, and we are happy to do that. Now let's talk about what and where. So what are we doing? We are drilling 4 brand new wells. Where are we doing it? We're drilling them in northern Louisiana in the Claiborne Parish or Claiborne County. And in particular, there's 2 different fields that we're going to be drilling in. One is called the Lisbon field, and one is called the Colquitt field. Now, drilling is going to start in late November. So if you're listening to this presentation and it's the 1st or 2nd week of November, know that drilling is going to start within a few weeks. And the first 2 wells are expected to be completed within 2024. Those wells are going to be drilled in the Lisbon field. And then the second 2 wells, which will be drilled in 2025, will be in the Colquitt field. And so we will have drilling costs. They're called intangible drilling costs that we can apply bonus depreciation to. So you will get bonus depreciation on your 2024 tax return K-1 document.
All right, let's take a deeper look at each of these oil fields and give everyone a sense of how we start to look at our financial projections. So this is a map, an overhead view of the Lisbon field. You can see the two stars are our proposed drilling locations, and the five circles are what we call offset wells, which is another way of saying comps. So in the real estate space, we call these comps, right? These are other neighboring wells that have a known oil and gas production. And so this is really critical for us to study this as we go into our investment analysis. Oil and gas is a highly regulated environment from the perspective of the data that's available and the reporting that's required. And so the year-by-year production values for the oil and gas is actually pretty well known for the neighboring wells, which are the offset wells. And we're going to go into this in a little bit more detail. I'd like to point out that three of the wells are across a line that we call the east-west line. And we look at the comp set or the offset wells as a whole. So 1, 2, 3, 4, and 5. And then we skinny that down to only look at the geographic east-west line to give us an even more conservative viewpoint of oil and gas production in the proposed drilling sites that we have. And so as we look at the data here in a couple slides, this is the geographic location of what we're calling the east-west line in our comp set. So here's two charts that we're going to study, and these are the offset wells. If you remember from the last slide, we had wells 1, 2, 3, 4, and 5, which were the blue circles. The chart on the right depicts all 5 wells, and the chart on the left is the east-west offset wells only, so wells 1, 3, and 5. So you can see naturally we've become more conservative in our data set here as the east-west line had a little bit of a reduced average over the total offset well count. But what's really important to note here, now again, this is production data for these 5 wells in the first 7 and 8 years of production. So the years across the horizontal axis. Some of these wells are very old, some of them going back 40 plus years. But this data shows what they were producing in the first set of years after they were drilled, which is a good indicator of how our wells will perform in the first 5 years of the investment horizon. So that's why we use these offset wells to give us a guidance on that. Second thing you'll notice is after several years of high oil production from the offset wells, it starts to taper off. And that's very normal in oil and gas. You'll have a handful of years that's very high, pressures are built up, it's extremely good production. And then as you consume the oil, it starts to tail off and get lower and lower each year. What you'll notice is in our projections, we are assuming that that tail actually accelerates, right? It doesn't follow the offset wells behavior one for one. We start to have that assumed reduction in oil output much sooner, as soon as year 2 and 3. And so what you'll learn as you study these comps and our projections is it's a very conservative. It's an added layer of security to our investment projections, so that when we start to produce oil and gas, we can hit our projections and exceed our projections. Now, I'd like to address one very common question that gets brought up for folks getting into the oil and gas investment space, and that is, okay, you're planning to drill wells in and around neighboring comps or offset wells. Haven't those wells already depleted the oil and gas out of the ground? Isn't it safe to say that perhaps they've already taken all the oil that's underground? And the short answer to that is no, that's not exactly how it works. So first of all, it's important to note that our ground lease for these wells that we're going to be drilling are in 320-acre plots. So the map of the Lisbon field, for example, is actually a very, very large area. and the wells themselves are actually far apart. They're not very close to each other. And secondly, geologically speaking, one might think that when you drill these oil wells, they all go down into the ground 10,000 feet and enter one large pool of oil. And that's not how it works geologically. There's various factors to consider, rock porosity, different geologic formations underground. And that's really, bringing up Emily's point from a prior slide, that's really where Rosestone and their expertise in the partnership comes in, because for us to create these projections and study these offset wells, it takes that level of geologic expertise to put forth an investment projection like this, along with some conservative underwriting, of course. Even though we feel very good about the offset well production historically when they were drilled, we want to back off that a bit so that we can overperform on our projections. So I wanted to cover that piece of it because it's a very, very common question that gets brought up as folks get into this space.
So let's switch topics and start talking about gas production. So every well has the opportunity to produce both oil and gas. And so from each of the same offset or comp wells, we have historical gas production from those wells. Now, when these wells were built, some of them 30, 40 years ago, the infrastructure wasn't in place yet to transport and utilize the gas that was produced right away. And so for these production charts, you actually see less in the beginning, and then they ramp up, and then it goes down. Because we have all the infrastructure in place to immediately sell the gas that we produce out of the well, we have shifted that projected returns to start around year 4 of the comps. So you see both the east-west line off wells 1, 3, and 5, and you see wells 1 through 5 plotted against the projected gas production that we expect to get out of these wells. And again, we remain under the average well line, and this is a conservative approach based on the statistical data that we have.
One of the biggest takeaways from these set of charts that we've just reviewed is our green projections, which translate to the investment projections, are much, much lower than the neighboring wells, the offset wells, were producing in the first several years of their production. And again, as Emily mentioned, Rosestone has extensive experience studying the geology and the oil and gas production in this specific region, using these data points and then backing off the production data from our neighboring wells to a comfortable conservative projection for our investment is the best practice for us.
Now, there is a second field that we plan to drill in, and that is the Colquitt field. And similar to the last map, you see the 2 stars, which are the proposed well locations. And then you see the 5 comparable or offset wells. Now, we have similar data from the Colquitt field, or Rosestone has similar data. And the projections are fairly similar. The Colquitt field is projected to bring in about 1/3 of the production. The Lisbon field is projected to bring in about 2/3 of the total production. And together, again, like Adam mentioned, Rosestone has put together the pro forma to be extremely conservative and achievable based on the data that they have. So let's talk about the assumptions for the returns. So the assumptions in the underwriting have that we will drill 4 wells and that all 4 wells will achieve their primary targets, those green dots that we showed you on the comparable slides. Now, we also take into account pricing for oil and gas. And so we use a published forecasted pricing guidance, and those are available in the appendix slides. But we also take a we reduce those to say that, well, we're not actually going to achieve that forecasted pricing. We're going to achieve a little bit less. So we base it on those forecasted pricings in future years, and then we reduce that number. We are also assuming that the wells are going to be sold in year 5. And you may remember the declining production curve when we talked about the comparables. And there is still a market value for wells that have already been built, that are producing. And so there is projections to sell the 4 wells at the end of the 5th year. Now, this all culminates to a 411% return, which includes the principal payback. So 4.1x equity multiple and a 62% IRR. Now, the actual breakdown of the passive investor and the lead investor returns is that there is a 12% preferred return in place. So the passive investor will receive 12% preferred return first. And then after that is achieved, it goes to a 75-25 split. And the passive investors get 75%, the GPs get 25%. So you see the annual breakdown. This is where you can see that in that very first year, 146% projected return, meaning you get your entire principal payback plus an additional 46% in that first year. And you can see the average, the sample based on $100,000 investment. So down to the bottom, you see the 4.1x. And this is a testament to the strength of the cash flow of this project.
Now that we've looked at the projected returns, it's important that we talk about how we've stress tested the model. As with any investment that Emily and I do, we always take the current baseline projections and we run a couple scenarios to ensure that it's still a decent investment as we see certain things come up in the economy or the marketplace. We try to see what the model does based on these scenarios. And so you can see at the top there, we've listed out the baseline model, which Emily just reviewed. We have 2 stress tested scenarios, and then we have a final upside scenario, which we'll talk about. So the first scenario where we stress tested the model was assuming that the price of oil doesn't stay where it is for the full 5 years. In fact, we did a simulation where we ran the oil price at 50% of the model's assumption for all 5 years. So instead of, say, $68 per barrel, we're going to sell the oil at $34 a barrel, so a 50% haircut on price. And you can see where the model comes in there on returns. So it would be 2.7 times your investment, or for a $100,000 investment example, $270,000 over 5 years. You can see in the column on the right there, I list out the year that the principal gets paid back, just to give you an idea, like Emily said, of the strong cash flow. The second scenario we ran through was, hey, what if we drill 4 wells, but 2 of them actually produce no results, so 2 dry wells. And this would be effectively 50% of the production that you might receive in the baseline model. And you can see there is essentially a 2.2x your investment, which is still very, very good investment. And so we were quite satisfied with the way the model was built based on these, I would call, relatively significant stress tests, both the pricing and as well as the production. To look at what upside might be contained in the investment, we go back to our east-west offset. If you remember earlier, we discussed that geographic east-west line of offset wells, wells 1, 3, and 5, that we say is probably going to produce close to geologically what our projections will. And of course, then we took a significant step down for our production amounts. But you can see if we produce what those wells produced in the first 5 years of their existence, what type of upside is in this investment. And simply just take the production levels of those 3 wells, plug them into the model, and you can see it produces a 9.3 times your investment, which is pretty significant. Of course, we don't project that because we want to stay conservative and overachieve on our projections. But in the case that we want to study what type of upsides might be in the investment, I wanted to list this out.
So let's talk about the other income opportunity. And this is not in the projections, so we are not counting on any income to come from this, but it is around Bitcoin mining. And what is so interesting, and this is the first time we've had experience with Bitcoin mining, is that in oil fields, when you drive around, you may see this fire being let off into the atmosphere, and that is burning methane gas, burning gases that can't be used so that they have less impact to the environment. Well, instead of burning them and letting them release into the environment, we can harness that gas, that vented gas, and use it to power a generator that can power a Bitcoin mining machine. And so you're essentially taking energy that was going to be wasted and putting it to work. Now, the Bitcoin that is mined can be sold in fractional coins. It can actually be sold as frequently as on a daily basis. So as soon as this mining machine achieves a fraction of a coin, it can be sold and for US dollars, and those dollars can be returned to the investors as additional upside in the deal. Now, Bitcoin mining is becoming a much more common thing in the oil and gas industry because it's giving an opportunity to increase revenue and reduce expenses. Because for large existing operations, the flared gas, the gas that is being burned, starting next year is going to be fined. The companies are going to incur fines. And so it gives them an opportunity to say, please use my gas so that we don't get fined. And so this has been done on another project. The project that just went full cycle with CapX Ventures proved out this concept. They purchased the equipment, they mined the Bitcoins, and they sold the equipment at the end of the project, all for great returns. And so for CapX Fund 6, the mining equipment has already been purchased, and we have already signed a lease to use vented gas from an existing well that is located down in Galveston, Texas, because our wells have not been drilled yet. They are not producing any vented gas yet. And so we have signed a lease to use somebody else's vented gas for almost free. It is at such a small amount that the energy is almost free, which if you're familiar with Bitcoin mining, the energy consumption is one of the most expensive parts of the mining. Now, again, none of these revenues are in the current projections, and you don't have to be a Bitcoin investor. You don't have to like Bitcoin. You don't have to want to buy Bitcoin. You don't have to set up a wallet to be able to benefit from the opportunity here, the opportunity to reduce the gases that are being released into the environment, and the opportunity to have additional returns and harness the energy that is coming out that we can't sell otherwise. So we are really excited about this other income opportunity that, again, is not in the projections, but has the ability to pay out almost on a daily basis to the fund, and that those returns can be given back to the investors.
Yeah, and just to reiterate, Will Crozier, one of the principals of CapX Ventures, he is an expert in this field. He's a pioneer, one of very few that is actually going out and doing this actively. And so, again, it's just an opportunity to get in here in the beginning while things are getting going with Bitcoin mining and oil and gas arena and take advantage of that in your investment. Let's go over once more just a couple high-level items for investing in the CapX Ventures Fund 6. Overall, the managers in the deal are investing north of $500,000 in this venture, and it has a minimum investment of $50,000. It's a 506c offering, so we are only able to accept accredited investors. Self-directed IRA accounts are perfectly acceptable. And so if you have a self-directed IRA, feel free to use that to make your investment. We are planning monthly distributions. So once we drill our first well and we can start monetizing that oil and gas, we plan to kick off monthly distributions. Funds are required in 2024. However, there is a caveat. Emily had mentioned that we are starting the drilling process in late November. Once we actually see oil or gas, we have to stop accepting money. Once we actually realize the production of oil or gas, the fund has to close. And so 2024, end of the year is a deadline. Or if we finish the first well and actually have oil or gas realized, that's the really true deadline. Just a couple tax considerations. As we mentioned before, a lot of the upfront drilling costs for the fund, we can accelerate that as bonus depreciation, so you can realize an actual loss on your first K1, of which you can expect in March of 2025.
So let's talk about next steps. If you are interested in seeing all of the offering documents, they are available on our investor portal, which is through Cash Flow Portal. You are welcome to click the link or scan the QR code. All of the documents are available for digital signature. And you are also welcome to set up a call with Adam or I if you want to talk about the investment. If you want to hear from us one-on-one, you've got my Calendly link, you've got Adam's Calendly link, and we welcome you to schedule a call with one of us to talk in more details. I want to reiterate, one of the reasons that we love this deal is because of the cash flow. And like Adam mentioned, when we looked at our portfolio 2 years ago and the market started to shift, we had a lot of multifamily investments that stopped cash flowing. And so it has been a big focus for us the past 2 years to add cash flowing investments to our portfolio. And so this one meets that need. And we are also really excited to branch into the oil and gas industry. One, because it's uncorrelated to the real estate market, and it brings us a lot of diversification for our portfolio.
Yeah, I think what we've realized over the past couple of years is that when you have investments that provide a higher velocity of cash flow and money coming back to your bank account, it gives you more control over your assets in general, right? It allows you to reinvest sooner. It allows you to gauge better health on your portfolio. If you need to make a pivot to a different asset class, you actually have the funds to do so. And so with our journey, diversifying our portfolio, as Emily stated, oil and gas is definitely going to make a huge impact. So we really are excited for you all to join us. If you have any questions at all, please respond to the email or schedule a meeting with us via the links. But we really look forward to working with each and every one of you.
Thank you.